Hello again, traders, and welcome to the Pro Trader Network. In this week's training video, we're going to discuss what does your chart say about you? What's on your chart and why is it there? Traders, take a second to pause this video, open up your platform, and really take a good look at your chart, and then ask yourself this question: what is on it and why? Here are some of the questions you might consider as well. How many indicators do I have? In what order am I weighing these indicators in terms of my trading plan and trading system? And do some of these indicators provide the same information? And if they do provide the same information, why do I have the redundancy on my chart? What is it that's requiring me to have so much confirmation for the same data? The next question you need to ask yourself is, why is this deluge of data required to make a decision? The market only moves in three directions. It's either moving up, down, or sideways. Those are our only options. So we have to ask ourselves, how much information do we need to decide? What do you think those additional indicators are providing? Why is there doubt in your mind that you have so much redundancy? What is causing you to second guess your trading plan and your rules? And what are you doing to overcome the fear and the necessity of adding indicator after indicator onto your chart? Take another minute to look at your chart again. What does your chart say about you to other traders that might look at it? Does it display a disciplined trader ready to attack the market? Does it display a new trader? Maybe you're testing several indicators as part of backtesting a system. Does it show a new trader that has not done backtesting or built a belief in their system and trade plan by virtue of the fact that it has 6 oscillators on it: MACD, RSI, stochastics? Do you have pivot points, Fibonacci lines, support and resistance lines, multiple pivots, daily pivots, weekly pivots, monthly pivots, and so on? Does your chart display a trader so unsure and so afraid that this reliance on these indicators is really used to absolve you of your own responsibility and actions as you engage the market? And that simply means, traders, you can blame the indicators. Well, I would have taken the trade, but the cross of my stochastics wasn't this. Or I got a signal, but I didn't take it because there was no confluence with my 7 oscillators on my chart. So based on what's on your chart, what is your perception of what's truly needed to make a decision to enter the market? And is it realistic? Do you need the confluence of 15 indicators to make a decision to go long or short, or to notice that the market is consolidating? Have you backtested your trade plan to determine what constitutes a valid trade signal? The point here, traders, is if you're relying on all of these indicators to align, the probability that you're going to have confluence on 5, 6, 8, 10, 12 indicators is virtually impossible. There will always be one indicator that won't confirm exactly what you think it should, and therefore you will hesitate and not take the trade, missing opportunity after opportunity, when actually maybe a combination of 1, 2, maybe 3 at most of these indicators would be more than enough to give you a valid signal as to the direction and momentum of the market. So when you see a chart like this, or if your chart is actually comparable in the amount of information and data being presented, you need to stop trading. You're not ready by any standard to start trading a live account. And furthermore, traders, this level of doubt, and I call this doubt by indicator overload, is a sign you need significant improvement in understanding your psychology and your approach to the market. This type of chart is what professional traders love to see. It's going to guarantee their continued profitability and reinforces exactly why so many traders lose money. Traders, if you've seen any of my videos or read most of my posts, you'll know that a reoccurring theme is that less is more. And here's my typical chart. This trend line, Heikin-Ashi candles, as you can see here, and an oscillator down here, an RSI. The lavender boxes here, they help me separate the days for quick reference if I want to look back and count the trading days during the week. Even though I use the TDI indicator, you can see that I don't use it all. The TDI also includes a market baseline, which I do use sometimes. It also includes Bollinger Bands, which I don't use. I prefer to use the 68, the 50, and the 32 levels to show me the overbought, trend change, and oversold conditions. I've thoroughly backtested my system, and I've spent lots of hours studying market structure, and that's why I can act automatically when my rules are met and I get a signal. This chart is also very easy on my eyes. Everything for me is very easy to see and analyze in a split second. And not that I need to. Normally when I'm scalping, I use the 15-minute chart. I'm practicing using the 5-minute chart. It still right now moves a little too fast for me, but most of my trades are taken on the 1-hour and 4-hour charts. Plenty of time to react, nice, calm, anxiety-free setups, nice, calm, anxiety-free entries and execution. If you're brand new, you're going to be more reliant on multiple indicators, trying to learn systems and so on. It still doesn't mean that you need to inundate your chart and your mind with indicator overload. You need to decide where you want to be in a reasonable amount of time. Don't think that you're going to master the markets in 2 weeks after being introduced to Forex trading. It takes time. I know professionals that have been hugely successful in a year's time. For me, it took a little bit longer if you've read my story, but our learning curve is individual. The great thing about trading is there's really no reason to impose an unrealistic time frame as to when you're going to trade full time or when you're going to go live. You have plenty of time to enlist perfect practice to make sure that you're consistently profitable, and then begin to scale up in terms of your risk, your account size, and your position sizing. As I've said, traders, less is more. Place only the minimum amount of indicators on your chart. The ultimate goal here is we want to get you trading based on pure price action. We'll start getting into the introduction of some more ratio trading, looking at confluence using some basic indicators like Fibonacci and our trend lines. But that's the goal. We want to be able to not rely on indicators at all. We'll use our reticular formation to train our mind to simply look at our chart and recognize patterns instantly, using a few minimum tools on the chart to determine the probability of where price might go and enter the market. The fewer indicators you use, the faster you will progress. You're going to rely more on price action and the nuances of price action and less on your indicators. That's going to accelerate your learning curve. The more indicators you put on your chart, the more interference that's going to create for your mind to determine whether or not you have a valid trade setup. Too many indicators on a chart simply reminds me of talking on the phone, watching television, listening to music, all at the same time. It's virtually impossible. Too many indicators has the same effect. It freezes your brain, creates analysis paralysis, and continually introduces doubt when it comes to executing your trade plan. So just remember, traders, less is more when it comes to indicators and information on your chart. We want to get you to the point where you're trading pure price action as soon as possible, and the less you rely on indicators, the faster you're going to get there. Thanks again for being here at the Pro Trader Network. As always, let's stay focused, follow your rules, and we'll see you next time.